If you're trading futures and constantly wondering where your money is going, the problem may not be your strategy. It could be the mistakes you're making before, during, and after each trade. Futures trading offers huge opportunities, but leverage can also make small mistakes very expensive. In this video, we're going to look at 5 common futures trading mistakes that can quietly destroy your account, and more importantly, what you can do instead. Let's get started. The first mistake is using too much leverage. Leverage can make futures trading attractive because you can control a larger position with less capital. But here's the problem. Leverage doesn't just increase potential profits, it also increases potential losses. A small price movement against you can turn into a large loss when your position is too big. Many beginners see a strong setup and think, this trade looks perfect, I should go bigger. Mistake number 2 is entering a trade without knowing where you'll exit if you're wrong. Before entering a futures trade, you should already know 3 things: where you're entering, where you'll take profit, and where you'll accept that your trade idea is wrong. Without a clear exit plan, emotions can take control. When the market moves against you, you may tell yourself, I'll wait a little longer. Then the loss gets bigger. You move your stop, you wait again, and suddenly, a small losing trade becomes a major loss. A stop loss doesn't guarantee that you'll avoid losses, but it can help prevent one bad trade from becoming a disaster. Remember, being wrong on a trade is normal. Letting one trade damage your entire account is not. The third mistake is overtrading. This happens when traders feel they need to be in the market all the time. You take one trade, then another. Maybe you lose a trade, and immediately try to win the money back. This is called revenge trading, and it can quickly create a dangerous cycle. The market doesn't owe you a trade every 5 minutes. Sometimes the best decision is to do nothing. Professional trading isn't about how many trades you can take. It's about waiting for situations that match your plan. If your setup isn't there, stay out. Cash is also a position. Mistake number 4 is allowing emotions to control your decisions. Fear can make you exit a good trade too early. Greed can make you hold a winning trade for too long, and frustration can make you enter a trade that you never planned to take. The solution is to create rules before you enter the market. For example, what setup are you looking for? How much are you willing to risk? Where is your stop? Where is your target? And what conditions will make you stay out? When these decisions are made before the trade, after several weeks, review your journal. You may discover that you're losing money during certain market conditions. Or maybe you're entering too early. Maybe you're taking profits too quickly. Or perhaps your biggest losses happen when you're trading emotionally. Your journal turns random experiences into useful information. So, let's quickly recap the 5 mistakes. Too much leverage, no clear stop-loss plan, overtrading, emotional decision-making, and not keeping a trading journal. Futures trading isn't about finding one magical strategy. It's about managing risk, controlling your behavior, and improving over time. Avoid these 5 mistakes, protect your capital, and focus on consistency rather than quick profits. If you found this video useful, subscribe for more simple futures trading education. And remember, protect your capital first. The next trade is always waiting. Now, let's take these mistakes one step further. Knowing what not to do is important, but knowing what to do instead is even more important. First, create a simple trading plan. Before the market opens, decide what setups you're looking for, how much you're willing to risk, and what conditions will make you stay out. Don't make these decisions after you've already entered a trade. Second, focus on one strategy at a time. Many beginners jump from one strategy to another because they see someone making money online. One day it's moving averages, the next day it's price action. Then it's indicators, signals, or another new system. This creates confusion. Instead, choose one simple strategy and spend enough time testing and practicing it before deciding whether it works for you. Third, protect your trading capital. Your account is your business capital. If you lose a large part of it, recovering becomes